Today we're talking about why most investors lose money even when they're not wrong. If you want to actually beat the market instead of just riding it, you need to understand how the best investor of the last 50 years actually thinks. Now look, I've gone through one of the most respected investing books ever written, The Most Important Thing by Howard Marks, the billionaire investor that Warren Buffett himself says he reads twice. And it turns out, there's only 4 mental shifts separating average investors from great ones. If you understand these 4, you will start seeing the market completely differently, and you'll stop making the same mistake almost everyone else is making right now. So in this video, I'm going to break all 4 of them down with real examples from Marx's own career, so you can actually apply this the next time you're about to buy or sell anything. Before I get into the 4 shifts, let's quickly talk about why most people get investing wrong in the first place. Understanding this one thing will change how you see the entire market. Marx says investing isn't about being right. It's about being more right than everyone else, because the price you pay already reflects what everyone else believes. If a company is obviously great, everyone already knows that, and the price already reflects it. So just being right about a good company isn't enough to make money. You have to see something the market hasn't priced in yet. That single idea is the foundation for literally everything else in this video. So the real question becomes, how do you actually start thinking differently than the crowd, instead of just repeating what everyone else already believes? And that's exactly where the 4 shifts come in. Each one of these is a way of seeing the market that almost nobody does naturally. And each one is something you can train yourself to do. All right, the first shift is called second-level thinking. And the good news is once you understand the difference, you'll never confuse the two again. When I say second-level thinking, what I mean is the difference between having an opinion about a stock and having an opinion about what everyone else's opinion already is. Here's how Marx lays it out, and this is genuinely one of the clearest explanations of investing I've ever come across. First-level thinking says, it's a good company, let's buy the stock. Second-level thinking says, it's a good company, but everyone already thinks it's a great company, and it's not. The stock is overpriced. Let's sell. First-level thinking says, the outlook is bad, let's sell. Second-level thinking says, the outlook is bad, but everyone's already panic selling, which means the price has overcorrected. Buy. Notice the pattern. First-level thinking only asks one question, is this good or bad? Second-level thinking asks a completely different set of questions. What does everyone else already believe about this? Is the current price already reflecting that belief? And if I'm right, how much money is actually left on the table after everyone else's opinion is baked into the price? This is exactly why being right isn't enough. Your goal in investing isn't to earn average returns. You want to do better than average. Thus, your thinking has to be better than that of others, both more powerful and at a higher level. If you're thinking the same thing as everyone else, you'll get the same result as everyone else, even if your thinking is correct. So, to recap, shift number 1 is second-level thinking. And the fix is this. Before you buy or sell anything, don't just ask, is this good? And ask, does the price already assume this is good? And what does the crowd not see that I do? All right, shift number 2 is understanding risk. Specifically understanding what risk actually is, because almost everyone gets this definition wrong. Most people think risk just means volatility, how much a price bounces around. Marx completely rejects this. He defines risk in one sentence that genuinely reframes the entire idea. Risk means more things can happen than will happen. Read that again. It doesn't mean bad things will definitely happen. It means there's a wider range of possible outcomes than you can actually predict, and you have no way of knowing in advance which one you'll get. Here's why this distinction actually matters with your money. If you think risk is just how much the price moves up and down, you'll avoid anything volatile and assume you're being safe. But Marx's point is that the real risk isn't the bouncing around. It's the chance of permanent loss that you didn't see coming because you only thought about the outcomes you expected, not the full range of outcomes that were actually possible. A stock can sit perfectly still for years and still be incredibly risky if the company is one bad earnings report away from collapse. And a volatile stock can be relatively safe if the underlying business is genuinely strong and the volatility is just noise. This is why Marx insists that real risk can't be measured with a single number, the way academics try to do with things like standard deviation. You can calculate volatility after the fact, looking backward. But the actual risk, the range of things that could have happened, you only ever see one outcome out of many possible ones, and you never get to see the other paths that didn't happen but easily could have. So to recap, shift number 2 is understanding risk correctly. The fix is to stop asking, how much does this bounce around, and start asking, how many different things could realistically happen here, and could any of them genuinely wipe me out? Now, before I go on to the last 2, I want you to notice something. Both of these shifts are really about the same underlying skill, seeing more possibilities than the obvious one. Second-level thinking means seeing what the crowd isn't seeing. Understanding risk means seeing the outcomes that haven't happened yet. Marx built his entire career on training himself to see what's actually there, instead of what's easy to see. All right, shift number 3 is what Marx calls the pendulum. This is probably the single most useful mental model in the entire book, for understanding where the market actually is at any given moment. Here's the idea in plain terms. Investor psychology doesn't sit calmly in the middle between optimism and pessimism. It swings like a pendulum from one extreme to the other, and it almost never rests in the middle. The mood swings of the securities markets resemble the movement of a pendulum, although the midpoint of its arc best describes the location of the pendulum on average. It actually spends very little of its time there. Instead, it is almost always swinging toward or away from the extremes of its arc. Marx describes this swing happening between euphoria and depression, between obsessing over the positives and obsessing over the negatives, and ultimately between assets being wildly overpriced and wildly underpriced. He gives a brutally clear real-world example from 2005 through 2008. In 2005, 2006, and early 2007, capital markets were wide open, everything felt safe, and people stopped worrying about losing money entirely. Their only fear was missing out on the next opportunity, so they stopped demanding safe prices and started overpaying for everything. Then, by late 2007 into 2008, with the credit crisis exploding, that same pendulum swung violently to the opposite extreme. Suddenly, nobody cared about missing opportunities anymore. The only fear was losing more money, so people dumped assets at prices that, looking back, were absurdly cheap. Here's the part that should genuinely change how you behave with your own money. When things are going well and prices are high, investors rush to buy, forgetting all prudence. Then, when there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell. Most people do the exact opposite of buy low, sell high, because they're reacting emotionally to wherever the pendulum currently is, instead of recognizing that it's a pendulum at all. So to recap, shift number 3 is the pendulum. The fix is to ask yourself, right now, in this exact moment, does it feel like everyone around me is fearless and chasing every opportunity, or does it feel like everyone's terrified and running for the exits? Whichever extreme you're sensing, the pendulum is about to swing back. All right, the last shift, and this is the one that requires the most courage to actually act on, is contrarianism. This isn't just do the opposite of everyone else for the sake of being different. It's something much more specific and disciplined than that. Marx's logic here is almost mathematical. Think about what actually has to be true for a market to hit a top. A market only rises because buyers outnumber sellers. So a top can only happen once. Literally everyone who was ever going to become a buyer has already bought. At that exact moment, there's nobody left to push the price any higher, which means, by definition, the moment of maximum bullishness, when everyone is most convinced things will keep going up, is also the most dangerous moment to be buying. The same logic runs in reverse at the bottom. The point of maximum panic, when everyone is convinced things will keep falling, is mathematically the point where there's nobody left to sell, because everyone who was going to panic sell already has. This is exactly why Marx says at the extremes, which are created by what most people believe, most people are wrong. Therefore, the key to investment success has to lie in doing the opposite, in diverging from the crowd. The crowd's consensus isn't just sometimes wrong at the extremes. It's mathematically guaranteed to be wrong at the extremes, because the extreme itself is defined by everyone already agreeing. This is genuinely difficult to act on in real life, and Marx is honest about that. It requires you to buy when the news is terrifying and everyone around you thinks you're insane, and to sell when everything feels fantastic and everyone around you thinks you're crazy for taking profits. Your brain is not built for this. It's built to follow the herd because historically, following the herd kept you safe. But in markets, the herd is exactly what creates the extreme prices in the first place. So to recap, shift number 4 is contrarianism. The fix is simple to say and brutally hard to do. When buying something feels comfortable and everyone agrees with you, get cautious. When buying something feels genuinely uncomfortable and most people think you're wrong, that discomfort is often the signal, not the warning. All right, guys, that's all 4 of them. As a quick recap, the 4 shifts that separate great investors from average ones are second-level thinking, understanding risk as a range of unseen possibilities, rather than just volatility, recognizing the pendulum swing of investor psychology, and having the discipline to act as a genuine contrarian when it actually matters. None of these are about having better information than everyone else. Marx's entire point is that almost everyone has access to the same information today. The edge isn't in what you know, it's in how you think about what you know. That's a skill you can actually build, starting with the very next investment decision you make. If this gave you value, drop a comment and let me know which one of these 4 hit closest to home, because I guarantee most people watching this have been doing first-level thinking their entire investing life without realizing it. I read every comment, and it genuinely shapes what I cover next. And if you want the full depth behind every one of these ideas, straight from Marx himself, along with commentary from investors like Joel Greenblatt and Seth Klarman, The Most Important Thing Illuminated is the book this entire video is based on, and it's absolutely worth the read. All right, with that, I'll see you in the next one.